Okay, folks, real quick review. All right, so we're looking at the euro dollars hourly chart. Last week I mentioned that we would most likely see a sweep of this clean area in here. Equal highs, way too clean for price to keep that like that. Small little inefficiency as well. So that's our target. That was something we were looking for, mentioned, and I shared also on Twitter, me outlining the levels specifically. Let's go into a closer look of how we traded up into that. So we closed in an inefficiency. That's what that shaded area is here. And above those equal highs, we went just above it a little bit. But I want to go into a smaller time frame in here, 15-minute time frame. You can see how price trades up to it, creates a short-term high, rallies one more time above that, right there. Now, whenever we have this condition where we've traded up into a level we've expected as a target, it can create reversal patterns. I wait for it to give me a clear indication that it wants to do that, because obviously going into this week, we're focusing on buying foreign currencies with the focus of shorting dollar, essentially, but we're not trading the dollar index. So if we're bearish on a foreign currency, but it trades into a target, much like I taught for model number 2 for charter members, you have to now reverse your role, because we've entered in an area of a reversal market profile. So when it happens, we drop down to a lower time frame, and I don't see it clear enough in here, which is the reason why I was on a 5-minute chart today. I'll zoom out. Okay, and this area right here, I had that shaded as the original consolidation. Now I do that because it's free level Twitter. Okay, it still works because it's fractal. The price action is fractal itself, but I'll show you when we go into the other chart for the mentorship level. You'll see what I'm talking about. But anyway, the consolidation here still pans out nicely. Return to the original consolidation, and I'll refer back to the Twitter chart and videos. You can see that in comparison to what's being shown here. The low rally up in here, slightly higher high right there, and then we have a low that's broken there. Okay, this candle being broken, this makes this a breaker. So it's a bearish breaker. Admittedly, I trusted the fact that we were going to sell off a little bit, so I went in a little earlier, illustrating the return back into that as a breaker. So I'm actually entering before the public or free membership level of my content. They would be looking for this ideal scenario. This is the low risk short, smart money reversal. The price breaks down below this low here. Once it does, trades back up into it again. Gives us a nice little optimal trade entry. I'll show you what that looks like in the other chart. Price trades lower, comes back again. Another optimal trade entry here as well. Liquidity below this low. They run for it, then come back up. Right in here, that is what I was talking about for institutional order flow drill entries. High to low, optimal trade entry. Sells off below the old low over here. After hitting the low, expanding down below through that, we had a little market structure shift here, low, lower low, and then the high taken out here. So I want to see if we've created the low for the week here. I'm studying that, and I'm also studying cable, which we'll look at briefly in a minute. So go over to a 5-minute chart with the actual market structure and the market maker sell model that I had on my charts that I'm not sharing with Twitter. This was the original consolidation I was working off of. Return back to the consolidation. So there's accumulation, reaccumulation. This run up in here creates another layer of reaccumulation. Smart money reversal, low risk short. You see the optimal trade entry from here to here, right up into it there, this level, and the expansion down to that level. Now this high to this low expands back up into optimal trade entry, sells off, We have another one, which I don't have on the chart, but it's here to here, and let's just outline it right there, and easy then, Michael. There we are. So low to high, sweet spot, bingo. It's also a breaker. So we have short-term high here that's rated. Goes right back to down close candle. Trades up into it. Bingo. Sweet spot, optimal trade entry. A lot of layering there. Goes to target 1. Beautiful. And then we have a little bit of a retracement thus far. So I'm going to take this off. We don't need it. The entries, you can see, are pretty sweet. And it was all based on this particular fractal. So again, in summary, we were looking for price to reach up into that level anyway, and we were talking about that last week. Okay, so once it gets there, again, do we stop trading? No. Do we look for new longs at that level? No. You have to allow the market to cycle back into a discount. What is that going to look like? You know, it can come down for sell stops, or it can come back and fill in some inefficiency. There's no inefficiency over here. Okay, so if we are to anticipate another trade idea, and we traded to a level we were looking for an upside draw in liquidity, well, this is completed now. So either you want to adopt a market reversal profile and trade looking for, in this case, we traded up into it. This gives us a condition that is a clear and obvious market maker sell model. And you just go back here and find the original consolidations, liquidity resting below that. They cleaned it up rather handsomely. So that's all I did today. You guys can see that and make sense from what I showed on Twitter relative to this. And the other business was the British pound. I don't think this thing has created the high of the week. Okay, this is way too clean, and I'll talk about that in a couple minutes. But right now, I want to talk about how this range here, this high and this low. Why am I picking that range? It's a lot of confusion. I got a lot of emails about that. So let me zoom in. So again, we like to look for previous day's highs and lows to provide context to what institutional order flow is going to present for us. Here is last Thursday's, make sure I'm saying that right, the week before's Thursday. Okay, so March 7th. We had the market run down below on Friday of that week, and then the next week we opened up and then traded higher, rallied through, came back down into that same low. This same low, you always want to have previous day's highs and lows in the last 3 days on your chart. For instance, right now we're on the 18th of March. Okay, so you want to look back 3 days. 1, 2, 3. So this day here on the 13th, that's how much you want to look back for previous day's highs and lows, because that's where the fractal swing highs and lows will form. Look at what's transpired here. We had a low on Thursday, a lower low on Friday, a lower low on Monday. This coming down to the level I've already outlined about what the gap and all that. Go back and watch last week's videos relative to this here, where you watch me actually buy the low as it was slamming down. I had expected this to create a swing low. Otherwise, I wouldn't have bought it here. There's all kinds of confluences around that. But more specifically, if we look at price like this, whoops, I don't want to do that. Using Thursday's low, and this is the range high that we created. So here's Thursday's low. Friday went lower. Monday, we trade a lower low, but then we pierce Friday's high and even trade through Thursday's high. So we created some measure of a turning point relative to the daily chart. I don't need to be on a daily chart to see it. So the range high that we created and all this retracement, I'm looking at the framework around Thursday's low. We sweep through it to clear up all the inefficiency in here and go back to the bullish order block and back to the gap on that previous week's opening. So I am interpreting this movement right here, all of this, that price action there, as manipulation. Now, manipulation is not going to be clean. It's not going to be pretty. It's going to be the ugly part of price action. It's going to be the part that takes your stop. It's going to be the part that scares you out of a move. Okay, all of those factors or characteristics relative to the aspect of manipulation. That's how I interpret through analysis. So if we take this portion of price action away, even the narrative behind all this over here, the market is in a range. Okay, Thursday's low, we create a high, and we're just banging around here. Now we did get one or two candle bodies that went below that, but I'm framing it on the context of a daily low. So if we're on this day here, on the 12th, go back 3 days. 1, 2, 3. That's Thursday's low. I'm not creating something new to form fit this. Okay, I even talked about this in the free mentorship, not mentorship, but the free members tutorials, the things I was doing before I even did a mentorship in 2016. You always want to look at the daily highs and lows in the last 3 days. It's just something that it's always been there in my work. I talked about it on baby pips even. So it's not like I'm creating something new here. But the element that causes me to trust Artemis is going to allow me the opportunity to get long if I miss this. Now you guys seen me. I recorded it as I entered it. As this thing was slamming down, I bought it. Okay, I was only like 1 or 2 pips off from the low. As it slams down, I'm buying that right there because I already understand what it's trying to do. If I would have missed the entry here, okay, say I would have missed the entry here and I didn't catch all this run up, what would I have done? I would have used Artemis. Because the range now, let me go over here. Good grief. There we are. Spread this out a little bit more. All right. So in my mind, as price is starting to rally up in here, we are now back inside of this range. It's only confusing to you because you're not annotating your charts using previous day's highs and lows. Now, how do you do that and not have a million different lines in there? That's going to be up to you because the color scheme that I use or the thickness of a line I use completely going to be a personal preference. Okay, so you just want to annotate your charts to reflect what the high and the low was as far back as 3 days. It's as simple as that because it'll help you see the turning points as they're forming with intraday price action. I'm going to see the intraday turning point that confirms a swing high and swing low before the daily creates it. And then everybody else that uses, that stupid little indicator that MT4 has, the fractal indicator, it requires 5 candles to do that. I don't need 5 candles. So looking at it like this, the range here, now again, it's the Thursday low, and I'm looking at this also as manipulation. So what we described here, okay, let's put it back. This is manipulation. So in other words, this value of price at, let me see what that is, 30.86. So 130.80 essentially is a level that they are sweeping. So they gathered up all the liquidity below it here, and look how fast they come back above it. They come back down to it, slammed it through here. You watched me buy it long right at the lows, and I caught 100 pips or plus in there. Then we came right back down into it here and traded around it during a dead portion of the daily range. Then we started the wind up going into the next day. No real retracement. Why? Because the work has already been done the day before, late New York session. So how do I use Artemis at this point? I look back here and say, okay, well, we're in this range. We created a swing low on the daily. This is manipulation. They sunk it below 130.80. So what we see here in terms of manipulation also exists in this. So everything below this price action here is all stop running. This is a market that's seeking liquidity below current market activity here. They're coming down, dipping into that. Okay, so the context is, I think this is the whole real area of value. Okay, in other words, this is fair value. Anything below that becomes what? Extremely discount. So they took price down, clean up all the sell side liquidity. One more time, they drove it deeper. Nobody wanted to buy this but ICT. Nobody was looking at this whole drop down, extremely rapid. Nobody wanted to step in there and buy like I did. No one did it. Okay, I bought it at the low, caught over 100 pips there. Now, I'm not bragging. I'm just stating that you guys are asking for this information. You want to know the clarity behind everything. I'm giving it to you. So I've seen this as manipulation, running sell-side liquidity, and then this is one more time they dip down below it, clearing up the imbalance, and there's no necessity for it to get down below here again because they've already done the work. So why am I using this range? It's Thursday's look back in the last 3 days on this day on the 12th. Go back and you'll see that's within the realm of 3 days look back. And it's not IPTA data ranges. It's just simply a way of using day trading model. You last 3 days highs and lows. You're going to find all kinds of setups based on that. So it helps outline market structure as well, at least my form of market structure. You don't see that anywhere else. So I can't counsel you to say go check out this and build your understanding up as a supplementary study. It's just nobody else is doing what I'm doing. So that's the basis of why that range is there. And again, the high is simply because we traded through, and that's the dealing range high. So we have to incorporate that and Thursday's low. And you can see that they whipped through it. In other words, think of this whole area. Okay. In other words, if it was the low here and the high here, say that was an Asian range, and we were looking at day trading like around the Asian range. This would be the Judas swing, right? Okay. So what happens when we get back above in the Asian range low? And I'm not saying it's the Asian range low, and I'm probably confusing you by saying this, but if we are trading below the Asian range low, and we're bullish, we want to be buying below the Asian range high. That's one of the filters for day trading using the Asian range with my material. So this would be an ideal entry. The only importance is that we're buying a down closed candle inside of an optimal trade engine. I'm telling you, if you go back and look at examples of this, when you find clear, discernible, and maybe this one isn't discernible to you, to me it is, because I've been doing it for a long time, and I understand market structure, I understand power 3, daily range, manipulation, I know where the liquidity hunts are. You'll get there, okay? You'll get there. Don't think because you may not have understood when I first showed you this, this is above my head, I'm not going to be able to understand this, and get frustrated. This is something you aspire to understand as you go further and further along in studying this material. You're not going to get it all, folks. I'm telling you, not going to get it all your first couple years. There's going to be so much learning that takes place after 24 months because you'll have concepts under your belt, but then you'll have application and seeing it. And then your growth after 12 months is good. 24 months, exponential. That's where the real work comes. And folks that come through the mentorship, and when they finish the 12 months core content, they're like, okay, well, I did all this. I really don't feel smart yet. Well, that's because you haven't applied it yet. It was a huge data dump in content, and that's just core stuff. We haven't even got to the hard-hitting stuff yet. You got to get into uncharted territory in the charter membership that they haven't even seen yet. It's a lot of foundation, a lot of things, and you can see here with this example, it's a lot of things that go behind why I'm doing what I'm doing. There's depth to it. It's not just frivolous little nonsense that people think it is on Twitter. And it's not free content. It's stuff that you got to study. And you have to weigh out what's being done here. And it's going to require you to be a free, independent thinker and not rely on what I'm suggesting either in my tweets or even in my weekly commentary, because I'm not covering every pair. I'm not covering every asset available in the Forex market. I'm not covering commodities. I'm not covering stocks. I'm not covering the bond market. Okay, so I'm just going to interject this too. I'm not talking about crypto. I get a lot of emails about that lately. I'm not going to talk about Bitcoin. I'm not going to talk about crypto at all. That's not what I trade. I don't do anything with it. And for me to even waste time talking about it in mentorship, you paid to be here. I'm only going to talk about the things I would put money behind. And I don't trust it. So there you go. I'm not trying to be mean. I'm just saying it's just the way it is. So hopefully it's just cleared it up. If it doesn't, I promise you we will see more examples of this. But Artemis is really just a way of getting in a market that you've already missed the move that was ideal. Okay, so you missed the stop hunt and you didn't catch this part of the day. Okay, no problem. It's not a big deal. I don't worry about it. So what you do is you get the range defined. Okay, pull your fib down. You got to be below 50% level, so you're in a discount level. Got to be in a kill zone, great. And it's inside the sweet spot. And optimal trade entry 79, 62%. You're going to be buying anytime it starts to drop in that area because you're actually going to be buying the down close candle. You are buying what would otherwise be later on seen as a order block. So you're buying the market as it forms the bullish order block. Think about that. Okay, that's insight. Not free level stuff. It's not regurgitated crap. It's it's totally different. Okay, once you understand what I'm showing you, you have a greater affinity for what it is that's being shown here, because I'm teaching you exactly how they add more to an existing position when it doesn't retrace. Think. Okay, so let's go back over here. What I did today, I was looking at this low here, and obviously these equal highs. Let me zoom in a little bit more. Get some more. Here we are. So we had these equal highs. I don't like this at all, and I think we're probably going to be running through that. In fact, I think we're going to take out this high as well right now. Now, I'm not holding a gun to your head saying, you better be bullish, okay? Admittedly, and I've said this to you all numerous times in the mentorship commentary, and I also made it very clear on the Twitter, because there's a lot of folks that are sending emails to me that are not in mentorship, and they're saying, I know you know what's going to happen with Brexit, and I know that you're going to know before it happens. I don't. I don't. Okay, I'm learning right now new information about how that is affecting the marketplace, and I don't feel confident at all. So I'm picking my spots very gingerly with the cable. So how I did it today, I looked at this low here. We stabbed down through it, okay, and I expected some measure of a rally to clear up these equal highs. Now, I was aware that we could fail to get to the equal highs. That's the reason why I took the bulk of the trade off at the fair value gap and liquidity pool, which I'll show you when we drop down to a lower time frame. But right now I'm just giving you the context. So this low I was looking at, that's a turtle soup. Then that was enough. It'll probably pop it up here and clean that up. Great. I took the majority of the trade off and left the stop at +1 or 2, whatever it was, and it came down and hit my stop. Who cares? Okay, I found the setup, took 20 plus pips off, and I'm good. I'm not going nuts about it. I would have rather seen, if it would have done this move here earlier, if it would have done it earlier, then I probably would have been buying it below the lows here as well, because we have equal lows here, small little gap right in here, so that would have been enough. Okay, could run some stops, run liquidity out below the equal lows. I think that's pretty much what they've done here. Okay, so let's drop into a 15-minute time frame. Okay, so this little move in here, right there, I like that run right there, breaking above the order block. I'm already in it. So I'm using the order block as a filter. I want to be buying inside of this down close candles range, and on the basis of they took out that short-term low I showed you on the hourly chart. But I also knew that we had a fair value gap in here. So if we include that, right there. Okay, so there's the gap entirely. And as the entry, institutional order flow entry drills, midpoint of that, okay, right in here, right there. So if you were looking at this area as a continuation going lower, this is an area where you could have practiced, entered in at the midpoint, but then you got to subtract a little bit for the pips spread, and then you would get in here. Look at the buy to the candles respecting the gap low. We spread up into it. You don't think that's institutional order flow happening there? Of course it is. Look at it. That is the reason why I took out the bulk of what I had on long. Because if I was wrong, I want to be out as it rallied up into above this high, where there's going to be liquidity, and also where institutional order flow is going to kick in. IPTA will be sensitive at that midpoint. Right out of your notes, this is exactly what I taught you last week. The middle of the gap, right there, boom, that's it. Okay, so consequent encroachment, that's what it is. Okay, that's the actual term. Okay, so the run down from there obviously hit the stop, and it was done. Then we have one more small little optimal trade entry in here, right before they really expanded it lower, clearing up those equal lows, which I can't show you here, so I didn't make any annotations about it. Now, interestingly enough, once it took those equal lows out, again, let me show it to you. Once they took these equal lows out, let me put this on here so that we have it right there. Oop, no, I don't want to do that. Put it on the lowest of the low, between this low and this low. We swept through it, and it's dropped back down into a 15-minute time frame. So that's that run on the equal lows. I would have rather seen that do it earlier, like ahead of 8 o'clock, not so late in the day here. But look what we happened. We swept through it, and then we're trading higher. This is dead. Okay, this is absolutely going to get blown out of the water. I'm confident it's going to do that. Now, what is it going to do after that? I don't know, because we have the Parliament vote tomorrow. It's tentative, and I don't know what that means. Okay, I would love to be able to sit here and tell you, I know it's going to do this, or I know it's going to do that. Okay, the only thing I'm confident in saying, I believe it's going to do it, and I know, and I might be wrong, but my conviction says they're going to clean these equal highs up. Think about the S&P daily chart. Okay, at that 28.25, 28.30 level. It was dusted, okay? They're going to do the same thing here. This is no different, okay? Just a smaller time frame. Now, is it tradable where we are right now? Is there something that we can do at the moment right now? Well, think. Do you see anything on the chart that you could use? This drop down, this becomes what? This is a breaker. We drop down into it here, right there. Let's see what the high is. 32.44, the low. 32.44 to the pip. Again, forget those little numbers at the end because they're pipettes. I could care less about that. Precision, and then we see a little bit of a movement higher. Now there is a gap right here. I'd like to see that stay open because that would represent a breakaway gap. And it would not need to be filled. It would imply that there's going to be a lot of strength and speed to get to these areas up here. There's a lot of jokers that are thinking they're right by calling the high of the week and being short here right now. I don't believe so. I think it's way too early. And with something like that vote tomorrow, who knows what's going to happen? I certainly don't know what's going to happen. But technically speaking, that's just way too clean for a price level. You got 1, 2, 3, 4 times. You don't think they're going to come up there and clean that? Everybody and their brother sees this. Okay? So if they think that's resistance, and everybody sees it as resistance, and they have their little lines across it, man, that's where all the liquidity is. That's where the market's going to go. If they can see that, okay, we have 1, 2, 3, 4 times it priced in. What caused IPTA to make that 4 times run up there? I don't know. I just know when I see it, IPTA will go back eventually and clear that out. Okay, so that's what I mentioned today on Twitter, that the 133 big figure needs to be sorted. Sorted means it's going to have to get up there and run that liquidity out. It could go up there and run it and go lower. Great, I don't care. I just want it to go up there because it's driving me nuts. Just like the S&P 28, 25, 28, 30. I'm handled now. I don't think it's going to go higher for S&P. It could. But it went where I wanted it to go. Okay, so there's no perfect little tabletop or shelf of perfect resistance like this that exists in price. It will always eventually clear that up. And in this case, with such a huge event coming out tomorrow relative to the fundamental aspects of GBP, it would be shocking to see them not come up there, at least run through that before it drops, or just completely just blow through it and there it is. So, hopefully it's been helpful to you today. I don't believe that there's going to be any reason to be in ahead of the Parliament vote for cable. So just study it and observe it. That's all I'm going to do. I don't want to do anything with it. I've taken a little piece of the action this week with it. And between that and Euro, that's my weekly objective. I'm done. I don't need to do anything else. Doesn't mean I'm going to be done, but it just means I'm not going to be doing anything tomorrow. Okay, so I might be trading on Wednesday, sharing some more examples on Twitter, who knows. Dollar CAD. Dollar CAD, I went short trading on a run back into a bearish order block and also a closure of a gap. And it gave me an initial drop down, which was nice, but I didn't like how it came back real quick. To me, that was indicative of it's wanting to go higher. On top of the fact that we hit that euro objective. So between those two pairs, I showed you without talking about it. I asked the questions, and then you guys fill in the blank with your understanding. But if euro dollar was topping out, and I had a short that showed a lot of retracement back up in terms of speed, and then started hanging around, I got to get out of there. Okay, and well, you watched me do it today. So is it plan B? No, it's adaptation. Okay, so we knew last week that that level on euro dollar was going to be influential because it's an objective. Okay, so once that liquidity is absorbed, what does that mean? You have to take a measurement of what's going on in the marketplace. I had a short, okay, right in here. That short wasn't likely to keep paying me if I was going to see a sell side delivery on euro dollar, because that means that currency is now weaker, freeing up the upside abilities for the dollar pairs that are like dollar CAD, dollar yen, and dollar Swissy. So, like I said, I dodged the bullet today. I could have went in and went long once it filled the gap in here. Okay, so you had a small little gap from the downside candle here, because this is sell side delivery. Let me zoom in. Okay, this is sell side delivery, and then all this is buy side imbalance. So you got to go back to the beginning of this candle right here. This makes it a bullish order block. Come on, should pop up. Here we are. The open is 33.24, same as the high. Trades down into 23. So 1 pip into the order block. That's where you buy. Small little gap between the open on the down closed candle or bullish order block and this low. Okay, it goes down just a little bit below it, where the midpoint would be for your institutional order flow drill, then tears off. We have another one in here. Okay, we have this candle here, very, very clear. Come on. Right in there. Okay, so we have this candle here, stops, does not fill in all of this, leaves it open. The next candle drops down right to the midpoint of the gap, right there. Add 3 pips or 5. There's your entry, going long, looking for it to expand on the upside. Why would you want to do that, Michael? Well, because I was telling you, euro dollar was going to go lower. Upside objective, clear the liquidity out here. Buy side, liquidity taken out right here, and then now we're down here. So we had 2 instances on dollar CAD here and here where you had an opportunity to practice with your order flow drills. My objective was to see it break down below here, but it didn't give me the confluence with the euro dollar creating a sell. So while I missed the ideal entry on dollar CAD, and I was negative, okay, relative to order flow. I was opposing. So I was short here, but order flow was bullish. I didn't get that confirmation until we had the sell signals form on euro dollar. So that's why I nixed it, bailed out, covered the position, and just moved to the sidelines. Okay, you can see the fair value gap over here I was working off of. Selling short into that. I wanted to see it drop down and take the liquidity out here. Didn't want to give it to me. So I was wrong, but it didn't hurt me. So that's what I'm talking about. This is not, and I didn't want to take a long in dollar CAD, okay, because it would just add more confusion, because there's some people in their mentorship that are tweeting, and you saw it today too, saying, well, you know, we were bullish on we were bullish on British pound. Right. I still am. I'm not saying I'm not bearish, cable. I was comfortable doing a short on Eurodollar because it makes sense. It traded up into a level that we were looking for as a target. So once that target's met, what do you expect? It to continue higher? No, because it's already moved up enough and it's run the liquidity out. So we can see a measurable and tradable decline. Then you go in and start looking for market maker sell models. Okay. In this case here, beautiful examples you can study. Have this in your charts. You should have this in your own study journal. Both these positions here, use those because that is exactly how we teach order flow to you. Okay, if you don't study or practice or take the examples that's shown like this in all your price action, you're not going to learn this, folks. It's not going to be watch a video and you know how to do it. You've got to take the information and practice in price. Even if you have to look at it after you come home from work, there's nothing wrong with that because that's exactly how I had to learn it. I did not have the benefit of watching live price action. I looked at numbers all day long on a screen, a quote track, little handheld thing. It looks like well, actually now the size of the phone I have. I have the Note 9, Samsung Note 9, and the quote track was just about as wide as this, a little bit wider, but it was the same dimension. It had like an extendable antenna, kind of like old transistor radios, and that's what I carried around with me all day long. It was just little numbers, always updating. I didn't have the benefit of seeing the charts, live like some of you guys have. And like I said, it's a worthwhile investment to get yourself a screen recorder and set it up where it's recording a 5 and 15-minute time frame chart. And that way you can actually see the signals form in hindsight and go back and watch it as it's doing it. Believe me, for like $200, it's such a wonderful asset to have because you can literally look at what would have been live at the time and you can relive it over and over and over again. And you can pause it right when it's doing something that you like, which you can't do that with live market activity. Like now I'm talking, it's still moving around. You can freeze it, take a screenshot, make all kind of annotations around it, okay, and then let it pan out and see what happens. That's an advantage that none of us had in the 90s. We didn't have it, okay? So, and anyone before the 90s, I came up in the 90s. People in the 80s and 70s, they sure as heck didn't have any of those resources. Now we have technology at our disposal, and you're wasting it if you don't invest a little bit. And the company I use to make these videos with is TechSmith, techsmith.com. It's Cam Studios, who I use to, that's the platform I use to record all these videos. And it's such a wonderful thing. It's awesome. Now, I have the privileges of being home all the time and being able to watch price action. You can see me recording it. If I'm out and about, I'll record it from my phone. If I'm still in bed, I'm recording it from my phone. So I know what I'm looking for, but if you want to learn how to do this with a really shortened learning curve, one of the greatest things you can do is invest in a screen recording app and just simply record your price action on certain sessions. If you have someone at home, like a spouse that stays home or a child that's home, you can have them turn it on at a specific time and turn it off at a specific time, or just leave it recording all day long. The videos will be really, really long, but who cares? It's something that you're able to use as a resource that no other mentor talks about. But it's available to you. It's a small little investment. You're not paying me for it. I don't get any kickbacks for it. TechSmith doesn't know anything about it. I use it because I've always been making it. Just since 2010 when I was making videos for Baby Pips. This is the same application that it's been upgrading every year. Beautiful, 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 beautiful package. Very easy to use. So that's going to be it, folks. I'm starting to ramble on now. Hopefully you've found some insight from all this. And I will try to do... I'm not going to do anything tomorrow. But I'm going to do some exercises on Wednesday using institutional order flow and the entry price drills that I gave you, which is simply just finding a fair value gap, trade in sync with the most recent move and or what you may view as the daily range or bias, and then just take out a previous high or a previous low. That's it. That's the drill. That's all you're looking for. That's it. Okay, and then if you can do that on a 5-minute or a 15-minute time frame, start applying it to a daily chart. It's the same thing, and then you'll be able to do swing trades and or position trades if you do it to a weekly chart. Once you have that, folks, everything changes. psychologically everything changes. You don't feel rushed. You know exactly what you're looking for. You know how to enter a market. You know how to frame the risk on it. You know how to look for the targets. Everything changes after you put the work in. But I can't do that for you. No one else is going to do it for you. So that's going to be it, folks. I wish you all a very pleasant day. I will be just sitting back tomorrow commenting on whatever we see relative to Brexit. Not trading and not really doing too much on Twitter either. So with that, have yourself a pleasant day. Good luck at trading. I'll talk to you all Wednesday in Market Review.